On today's show, Tom Lee's prediction for the S&P 500 in 2025, where and how to diversify your portfolio for next year, sentiment, and what to expect for the last 2 weeks of December. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and stocks fell on Thursday, weighed down by a hotter than expected US PPI report as tech shares failed to keep the momentum seen earlier in the week. Tech as a whole was down big. Google, Meta, Tesla, Amazon, Nvidia, they were all down in a very big way. What did help tech was Microsoft and Adobe, but the overall mood was sour in software as well as tech as a whole because Adobe was down 13% after it lowered its guidance, as well as Oracle's earnings report earlier in the week. Guys, all in all, it was really a mixed day across the board in healthcare, financials, industrials, real estate. Everywhere was just very, very mixed. We only had 3 sectors gain here today: staples, XLC, real estate, and then XLU was largely flat. And then from there, it was just steep losses from pretty much being flat here in the XLU to down 0.22%. The SPY fell 0.39%, and then every other sector lost as a result. Tech, discretionary, healthcare, energy, they were all down in a very big way. And pretty much we started the day off like that. There was very minimal upbeat action. We then pulled back to see declines for the day and sort of just traded sideways to down towards the end of the day here, with most sectors losing. And that's why we saw the markets decline across the board. But this is coming off a very big and bullish day we had yesterday. So there was some profit taking, but across the board, indiscriminate sell side action from large growth to small value. Every sector and factor size segment was really on the decline here today. And that really did see market breadth momentum take a dive. We saw some positive breadth momentum yesterday, slight improvement from the week prior. However, today we saw the 5-day and 20-day moving averages lose their 50% mark. That's not really good. Now, we do say that the 5-day is fairly noisy, but the 20-day is significant. A lot of quants use the 20-day, and you don't really want to see this. However, coming off the day we had yesterday, to be expected to some degree. However, the 50, 100, 200, and 150-day moving average, these longer-term breadth metrics continue to remain very robust. And this right here is just an opportunity for you to get long, because I do believe from next week onward, we're going to see very bullish momentum in the S&P 500. But let's actually talk about market movers today. Warner Bros. Discovery shares surged nearly 15% after the legacy media company announced plans to restructure and split its business into linear and streaming segments. This has actually been a stock on my watch list for a number of months now, but I never really pulled the trigger just because of the balance sheet. It's got so much debt to contend with, and its free cash flow isn't that substantial. It was a great value turnaround play. In hindsight, I should have pulled the trigger, but I didn't. Nonetheless, probably shareholders will see some value in its streaming segment, and depending on how they split it with HBO and Max, this might actually be a contender to Netflix and may actually be a stock we invest in the future. So we'll see how that split looks. I'll keep you guys updated. So go ahead, subscribe so you don't miss a beat. Now, Nvidia was down 1%. Now, there's a lot of news surrounding Nvidia from a China anti-monopoly probe, as well as some of the earnings we've seen in semiconductors. But today, I believe the stock was down, had its lows nearly 2%, because the Microsoft CEO Satya Nadella came out and said that they are not supply constrained when it comes to chips. Those are words you do not want to hear from one of your largest buyers, that they are not supply constrained when it comes to chips. Either they have enough chips, the chips are working really, really well, or they just have other competitors that they're going to now. Either way, I think this is why Nvidia was down and part of the reason why the tech sector was down, and that could really affect Nvidia sentiment into 2025. We'll see how that pans out for the rest of the week. But the big one, Adobe down 14% absolutely horrid day after the company issued weak guidance for fiscal year 2025. The worse than anticipated outlook stoked investor fears that AI will disrupt Adobe's business. TD Cowen downgraded the stock to a hold rating. There were a bunch of downgrades. Still, the overall rating for the stock is still buy, and a 14% pledge does look very, very attractive. So this might be a stock that I actually go ahead and look at. Nonetheless, if you're going to issue weak guidance, this is what's going to happen to your stock. Adobe feeling the pressure right now. They actually did do a double beat, by the way. It's just the guidance figures. The street want nothing to do with weak guidance into 2025. You really need to produce earnings if you want to see robust returns into 2025. Now, another reason why stocks actually were kind of weak and tempered today had to do with the PPI. The November Producer Price Index came in hotter than expected, rising 0.4% from the previous month. PPI Core came in line. It's just a headline figure that missed. Initial jobless claims also added some sourness to the overall market. 242 initial jobless claims are reported. The consensus was 220. However, we did see positive revisions here compared to last month. So yes, we did miss some initial jobless claims and missed by a lot, but revisions were better than expected. And then we also had a fairly positive 30-year bond auction. And all of this economic data and price action led the market to keep Fed rate cut probabilities where they are. We still see about a 90% chance of a Fed rate cut of 25 basis points in December. But what we saw was a substantial increase in the January hold probabilities. Sentiment probabilities went from 52% to 79% of a chance of a hold. So the market is really gearing up for December to be the last cut before we actually go on a little bit of a pause and then continue the cutting cycle. You can see here that the market future implied probabilities do see a little bit of downward momentum. So too do the Fed's FOMC projections, and Morningstar's forecast also sees downward momentum, but that's not before we actually pause in the month of January and then continue the cutting cycle sort of in the second quarter, March, April 2025. Nonetheless, we're going to see how this evolves because it is dynamic. It's not something that is set and forget. It changes with every single data point we get every single week. Now let's hop on the charts. And looking at the charts, we see a pretty ugly day for equities in aggregate. The S&P 500 down 0.5 percentage point, the Nasdaq down a little bit more, but that was coming off a very solid day we had yesterday. As you can see, the S&P 500 had a gap up and go, and today we had a slight gap down, and we're pretty much where we opened yesterday, a little bit lower. So we are looking to close this gap. We'll see what happens in the last couple of minutes of this trading session. Nonetheless, we're seeing a pretty ugly day across the board. The IWM down 1.4%. So, a very ugly day in small caps. Small caps are higher beta. So you're going to get more upside potential, but also more downside potential. And you do have to contend with that volatility. The RSP, the best index here today, down 0.34%. Just looking like a normal day, a normal down day in the RSP. But this is coming off what has been a pretty crazy sell-up, as you can see right here. Pretty much like 10 trading days of just downward momentum for the RSP. Very consistent down days. And this just marks another one for the RSP. However, that's not the same sentiment in something like the Nasdaq 100. We're actually still very up for the week. We've seen pretty much very linear returns with some red days in between. And nonetheless, equities were red and you probably took losses across the board. Yields did gain, the dollar was strong, bonds fell, and metals fell as a result of that stronger dollar, with silver down nearly 3%. And then looking at the S&P 500, down 0.5 percentage point today. I mean, the market sort of just giving some gains back as of yesterday. There was a couple of market moving events, news, especially with stuff like Adobe and what we heard from Microsoft CEO about Nvidia, and Nvidia down 1% didn't really help the overall market today. Nonetheless, we are still in that churn period of December. So any volatility that we do get this month or in the next couple of days, expect it. The real bullish part of December, the second half, actually only starts next week, Tuesday. But you could pretty much say from next week, that's when it starts. All in all, we've actually had a bullish December so far. Starting from here, it's been very bullish for the S&P 500, particularly for the Nasdaq 100. We've seen very linear returns in the Nasdaq 100. And then in stuff like the RSP and the IWM, we've seen fairly muted action. Now let's actually talk about the Russell 2000 because we saw we were consolidating yesterday here at the gamma flip, and now we've actually had a very ugly candle, a 1% down day, and it looks like we're going to close at the lows of the day. So we are officially in negative gamma. This means we now target the 2320 level. If we are to move lower, bulls really need to see and find consolidation right here. If they do and continue to move higher, that would be very positive because it would be a higher low relative to this low right here. We want to put in that higher low, and then if we can go ahead and break some of these highs on the way up, that would be trend continuation. Nonetheless, we are in negative gamma here for the IWM, and that means you have to stay cautious and buy into weakness, sell into strength, and ideally what you're really looking for is consolidation for you to buy the dip for us to then move back into positive gamma and then move up to back to 52-week highs. That's the play now for the IWM. We're looking for a place to consolidate. I would say maybe not here. Don't buy just yet. Give it a couple of days, see where this ends up, and then go from there. Nonetheless, a very volatile index, and if we could push back up into positive gamma, that would signal a buy into tomorrow. But you do have to take into consideration we are in negative gamma, and that does lend itself to us moving towards support as the 2320 level, which is above this zone right here. So we do need to hold this zone. Otherwise, if we put in a lower low, not good overall, but things looking still very constructive for markets as a whole. The RSP, a very crazy sell-off here, just 10 days of downward price momentum. It's sort of at this very, very key level. I would be a buyer right here for the RSP, aiming for the 200 region. And then looking at the Nasdaq 100 and the S&P 500, to be honest, nothing crazy. The Nasdaq 100 was up 2% yesterday, down 0.57% here today, giving some gains back. That's how the market goes. I would still be a buyer of any dips we do get. We are still in positive gamma, and I still want to aim for the 22,000 core resistance in the Nasdaq 100. And then the S&P 500, same story. I do see a little bit of upside potential. And again, I want to be positioned for the end of year rally that's going to stem towards the end of December into possibly Q1 January. I'm still very bullish on us going higher into the end of the year and us going higher into 2025. And pretty much, guys, any dips we do get over the next couple of days, by those dips, we still have a little bit of gains to squeeze out in the S&P 500 and the Nasdaq 100 before the end of the year. So buy the dip, don't trip. And guys, let's talk about sentiment. This is the AA sentiment survey. We see some very bullish results. We did see a downtick in bullish sentiment votes, but, above the 40 mark, still very bullish. Bearish sentiment still at the 30 level. This is still below the historical average. And neutral sentiment still at about 25%. And a bullish AA sentiment survey is often a great sign for stocks. When optimism prevails, it reflects growing investor confidence in the market's direction. Historically, guys, bullish sentiment tends to coincide with periods of strong momentum, like we're seeing right now, as higher confidence fuels strong momentum and buying activity. This positive cycle can and often does drive stocks higher, especially when the outlook aligns with improving fundamentals. And at the end of the day, when you look at stuff like seasonality, moving into the second half of December, it is historically been the strongest period of the year, excluding the first half here in July. You can see that the second half of December, and this is what we go into from next Monday, often returns about 1% since 1928, a huge pool of data. And this is very bullish seasonals. And here's the kicker, guys. We get a very bullish second half of December, and then we actually go into the first half of January, the second half of January, February, and March, and we see very bullish momentum, all things considered. So we are not just heading into a bullish seasonal December, we are heading into a bullish seasonal period. And when we have bullish seasonals and when we have bullish sentiment backed up by solid fundamentals that smashed analyst expectations, you're going to get the market momentum we're having right now. And S&P 500 earnings for the third quarter, smashing analyst expectations, nearly doubling it. 9% versus the expectation of 4.7% in earnings. Margins beating expectations, revenue beating expectations, and the big sectors, comm services, tech, healthcare, financials, all producing double-digit earnings growth. That's exactly what you want to see in a market that's driven by fundamentals. And this is why stocks continue to rally. But Q3 is really in the past. We need to look forward to the future. And Q4 earnings looking at double-digit growth as well. Right now, we're looking at forward blended earnings growth for the fourth quarter of 11.9%. The best performing sector being financials, seeing nearly 40% growth, 39.1%. The worst three performing sectors being energy, industrials, and consumer staples. All in all, Q4 earnings looking very robust. However, we have seen a little bit of a pullback in terms of revisions. We've seen the fourth quarter here seeing a 2.5% revision. Now look at the third quarter 2024. We saw very much of the same, and that meant expectations going into this earnings season were fairly muted, and we're seeing probably much of the same. So we could be setting up for a very big beat and an even stellar Q4 into Q1 and Q2 of 2025. And that's exactly what Tom Lee from FundStrat see. This is Tom Lee's chart and his expectations for 2025. Now, take this with a grain of salt. He's looking 12 months into the future, and nobody can actually do this type of analysis. 3 months, sure, but 1 year? This is, I would say, somewhat fugazi. You're sort of staring into the abyss and just chewing on glass. And what he really sees is a first half rally all the way to the 7,000 mark and then a pullback to finish the year at the 6,600 mark. Pretty much a 10% return from where we are. But to get to the 7,000 level, we see about a 15% return from where we are right now. So he's very bullish into the second half. And then he sees stuff like geopolitical concern and economic woes coming to front of market, especially as the Trump administration gets going. And that should lead the S&P 500 to finish at the 6,600 level. Still a very solid return, all things considered, but definitely a pullback from the highs that will be material and will affect investor sentiment. Nonetheless, that is what he sees. Now, we could get something like this. We could blast past 7,000. It all depends on what we get with the technical, the macro, and the fundamental. But something that could actually support the bull market into year end is actually short interest. This right here is the S&P 500, and this red line is total short interest. And there's been a 3.5% increase in short interest on the S&P 500 into the month of December. As the market has gone higher, short interest has also increased steadily. And this is what a fighting tape looks like. Now, many people might look at this as bearish, but for me personally, going into one of the most seasonally bullish time periods of the year, I see this as upside fuel with shorts needing to cover, sending the market higher above 6,100, maybe even to 6,150 into the end of December. All in all, I don't think you want to be short right now. Momentum is definitely in the market. You really just want to get on the train. You don't want to get in front of it. And diving into the macro, the US economy sitting on very solid footing. Atlanta Fed's GDP now sitting at 3.3%. After the data we got this week, it actually didn't change, didn't move to the downside or the upside. So 3.3, 3.2% looking very solid, especially as inflation continues to move lower, particularly the parts of the inflation picture that matters. Shelter inflation has been the sole reason why inflation has remained sticky in the last several months. But in yesterday's CPI report, we actually saw some very positive momentum in CPI, and that's actually why stocks did rally yesterday. We saw shelter inflation print 0.3% versus 0.4% last month, and a clear moderation in shelter inflation as nominal figures and core figures continue to tick up. Continued shelter disinflation and moderation will actually see the overall inflation and core inflation get to the Fed's 2% target. In fact, we are already there with the core figure. And this is a really good thing because it somewhat shows that rate cuts could be taking the pressure off homeowners and renters. And this is an overall really good thing, really constructive. And that's why the market really did rally yesterday, particularly the mega caps. So if shelter inflation continues to do what it has done in the last couple of months, we will see the Fed's target get to 2% at the end of the year. A lot is dependent on the shelter component of inflation. And with yesterday's market data, it is all but certain that we will get a rate cut next week at the FOMC. The market is pricing in a 94% chance of a Fed rate cut of 25 basis points. There's nothing really between now and next week that's going to derail that. Probably are going to get our rate cut. That's very, very good for stocks, the economy. I don't know what to think about with regards to inflation. We're seeing positive momentum, but we'll see how the inflation picture with regards to these rate cuts pans out in 2025. And one of the best ways to play the rate cut fever, except through equities, is actually through gold. Goldman Sachs believe that if the Fed cut by 25 basis points, that suggests a 2,900 or 2,890 gold target by year end 2025. And if we actually see recession cuts, the baseline, or a higher terminal rate, this is what we can expect gold by year end 2025 and then year end 2026. And by the end of 2026, if we get recession cuts, Goldman Sachs see gold at 3,100. Their baseline target is a $3,000 gold, and a higher terminal rate sees about a $2,900 gold. So all in all, they're pretty bullish on gold regardless of what rate cuts do. We are simply in a cutting cycle, and that bodes generally well for inflation hedges and currency hedges like gold, silver, Bitcoin, and precious metals. So if you do want to diversify your portfolio, look to something like gold or precious metals. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.